we headed into a recession? If so, what does that mean for housing? What does that mean for mortgage? What does it mean for homeowners or for home buyers? I'm going to break it all down for you today and give you a really good overview of what is a recession and then what does it mean for the markets. So whether you are a first-time home buyer or a seasoned homeowner, whether you're looking to simply stay where you're at or you're looking to make a move, this is critical to understand what it means for the markets if we do end up in a recession and what you can expect based on historical information. So first of all, what is a recession? Well, there's not a very clear definition. Historically, it had been 2 consecutive quarters of negative GDP. What the heck does that mean, John? It means that 2 quarters or 3 months in a row, twice, where the amount of goods and services created by the United States has shrunk compared to the prior quarter. So every quarter at the end of the quarter, actually a couple months afterwards, they're revising the numbers. The federal government's coming out with information saying, hey, did the economy grow or did it shrink? Did we produce more goods and services than the prior 3 months or fewer goods and services than the prior 3 months? And so that is the good old-fashioned version of the definition of what is a recession, 2 consecutive quarters where that number goes down. Now it's kind of changed. 2020 specifically made that change because 2020, we were in a recession because of COVID, and it happened overnight. It wasn't about 2 consecutive quarters. It was about the dynamics in the economy changing fast enough and drastically enough that the federal government warrants that this, yes, would be considered a recession. So there's a little bit of a vague definition there, but technically the government gets to decide when we're in a recession. No longer is it technically simply 2 consecutive quarters of negative GDP. But let's assume whatever the idea of the definition, in general, what a recession means is people are losing their jobs. Companies are closing down. Businesses are slowing down because they don't have enough buyers for their goods. Now, if we look at what's happening right now with the tariffs and what Trump is imposed, basically the president is saying, hey, we want people to buy American goods. Well, the problem is American companies aren't necessarily set up to provide those goods. And so you've got consumers that are going to, and you also, more importantly, have American companies that sell their goods overseas. And so those companies are going to lose revenue because you have overseas buyers that are adding tariffs on their side. There's a lot of other nuances to what is causing what could likely be a recession as a result of the tariffs. But what ultimately is going to happen in a recession is unemployment rises. Businesses start slowing down, they start laying people off, and you often will go from an average unemployment like we have right now of around 4% to a high unemployment would be double digits, 10, 11, 12%. There's a thought out there that if we do end up in a recession, we might end up at 8 or 9% unemployment. Well, that means that anywhere from 4 to 8% of the people who are working today could lose their job. But it also means that 92 to 96% of the people that are working today will still be working even in a recession. There's an old joke that says, what's the difference between a recession and a depression? A recession is when somebody else loses their job. A depression is when you lose your own job. Okay, maybe not something to make fun of, but it is an old joke. I didn't make it up. And the bottom line is a recession means there's a segment of the population that will lose their job. And so you wonder, well, how can that be good for housing? It's obviously going to be bad because you got people that are going to be going into foreclosure. Yes, there are going to be people going into foreclosure, but you have a significant amount of equity in homes. And so many of those people that are going into foreclosures actually have a lifeline by using the equity in their home when they sell it in order to rescue themselves and have that money to live on when they're out of work. There's also a large segment of people who are dual income families that they can still survive on one income. So they might be in a position where they refinance their loan in 2020, they have a super low interest rate, and they just have to cut back on all of the other things that they're doing while one party is unemployed. There's some people who are deciding, you know what, I'm going to go ahead and retire instead since I've lost my job, and now they're getting Social Security or retirement benefits, or maybe they're taking out a reverse mortgage. The serious part of this is not to be overlooked. I'm not telling you this isn't a big deal for those that are impacted, but what I am telling you is it's a small segment of people that are impacted, and we have a huge amount of equity right now. And you're going to say, John, that sounded like exactly what we dealt with in 2005. Let me show you some numbers. So here we are looking at the median sales price of homes going all the way back to 1965. And you see here where values went up and up and up, kind of like what we're seeing right here, where values are going up and up and up. You're like, John, they went up and up and up, and then they crashed because of a recession. That recession was because of housing. So housing caused that recession, and it was caused because we did bad loans that we weren't supposed to do. And all of these homeowners that bought homes in the early 2000s, they got them on adjustable interest rates, which means their rate was going to adjust at some point down the road. And the road happened and values had dropped. And so somebody who bought right here, and they said, well, I can refinance in 2 years. And so here we are in 2007 or 2008, and they go to refinance and the value is lower and they can't refinance. They still had their job. They still could afford their payment, except their payment was going up because they took out an adjustable rate mortgage because that's what everybody did. And so in this situation, it was a domino effect that somebody lost their home because somebody else lost their home, and that caused somebody else to lose their home. It was a contagion, a domino effect, a disease that spread through the housing market that caused a significant drop in prices. This gray area, the gray bar, is a recession. And so we saw a significant drop in prices during that recession. Most other recessions, prices drop a little bit and then they shoot back up. And it's because interest rates end up coming down. Now, interest rates came down in the 2008, 2009 recession, but you had a bunch of people locked out of the market. You had so many people who lost a home and they were upside down. We don't have that now. We've got a significant number of people that have equity in their home. Now, maybe if you bought right here, Q4 of 2022, and you lost your house, now you're down. You bought at 442 as the median price in year and 2.5 years ago, and now price is 415 average price. So you lost $30,000. That person is going to have a short sale. That person, if they lost their job in a recession, is going to have a foreclosure. They are going to be impacted negatively, but we're talking about a very small segment of the population. 4 to 8% of the people working today could lose their job. Of those 4 to 8% of the people, what percentage of those people bought their house fourth quarter of 2022? I think it's a pretty low number. I feel horrible for the people who are in that situation if they were to lose their job and not be able to continue making their monthly payment. But it's a small segment. We're not going to see a huge reaction to a foreclosure crisis like we saw in 2007, 8, and 9. So we're not going to have a repeat of what we had before. What we have is a bunch of people with equity. Some of them are going to tap into that equity in order to live. Some of them they have home equity loans and lines of credit. Many of my clients are getting those home equity loans and lines of credit now so that they have reserves to tap into later if the economy does slow down. So they're taking some defensive positions today, and I can help you talk about that if that's something that you would like to do. But what we want to look at is so first of all, in recessions, you typically have house prices that dip a little bit and then they shoot back up. In 75, they shot up a lot. In 1980, they shot up. In 1981, a back-to-back recession, we had prices drop some and then they shot up. In 1990, we had prices drop right before the recession, and then they went up during and out of the recession. 2000, the dot-com bust, we had, what was this? This is a 6-month timeline that we saw, 9 months that we saw housing prices drop, and then they immediately shot back up because interest rates came down. And so if we look at even just this one right here in 2001, and I go over here to show you interest rates. In 2001, we saw interest rates were kind of jumping around, and then boom, by the time we hit the recession, interest rates fell significantly. We go all the way back to the Ronald Reagan era, and we had inflation rampant in the 1970s in Jimmy Carter's era, and then Reagan comes in, and he says, you know what, we're done. We're going to raise rates as high as we need to in order to get rid of inflation. And he did, and he threw us into a recession. Well, Trump's thrown us into a recession for a different reason. Whether it's going to work or not, I don't know. Reagan, it worked. Reaganomics worked. He took us out of a recession. He put us into a recession. But the recession was the bad tasting medicine that you had to take to get us out of the stagflation we were dealing with in the late 70s. Trump believes that we are in a different position now, where America is being taken advantage of by our trading partners. I don't know if he's right or wrong. He believes that America will do better if we bring jobs back onshore. Sounds right, but who knows what's going to end up happening. But he believes that is going to help us. And what we're looking at here is an example where Reagan believed it was going to help us by raising rates, causing a recession, which is the bad tasting medicine you have to take in order to flush out the bad things that are in your system or that are in the economy. That's essentially what Trump is doing right now. Whether it's going to work or not, we don't know. But you see rates drop significantly through that recession. And then we've got the recession here. Rates in 1990s dropping significantly. 2000s dropping significantly. Even in 2008's recession, we saw rates up in this range. They dropped significantly. Same thing right here in 2020. Every recession, rates dropped significantly. And so if we look at these two things laid over each other, you see that when we hit a recession, this green line is interest rates. The blue line, let's make the blue line pop up. Come on, blue line, where are you? I know you're right there, but you're not popping up for me. The blue line, right there. So the blue line is housing prices. And so you're seeing that in a recession, you see interest rates right after that recession are coming down. During that recession, they bounce around. So it is a balancing act that, generally speaking, you have a new dynamic that we didn't have existing back in 2020, in any of the prior recessions, and nearly as bad as what we do now. And that's the issue of supply or lack thereof. And that story starts, and I'm going to give you a quick 5-minute story on why we have a supply issue, because we go back to 2007. The market crashed and builders stopped building homes and home buyers stopped buying homes. And so now you end up in a position where between 2008 and 2015, there was very little buying activity, yet people were still becoming of age where they formed a new household. So when you have children living at home and you have 2 kids at home, and when they turn 21 and they go to college and they graduate at 25, and maybe I got my dates there wrong, ages wrong, but you get my point. And then they go out in the workforce and they either buy a home or rent a home. They formed a household, meaning it is another unit being occupied without vacating the original one, because mom and dad stayed in the original one. The kids created a household. Well, guess what happened in the early 2010s? You had the whole adulting. I don't want to be an adult. I'm going to move back home and live with mom and dad. I don't need to be out there buying a home or renting a home. Mom and dad's basement is just fine. Okay, so you had builders not building, you had buyers not buying because they lost a home, or buyers not buying because they didn't want to become adults, because they saw mom and dad, auntie and uncle lose a home in 2007, and they thought home ownership's for the birds. I'm not buying a home. And everybody was even. You had no homes being built and no homes being bought or needing to be bought in general. And then we fast forward to 2015 and builders start building again. And then we fast forward to 2020 and buyers really, really, really want to buy again, and builders can't build fast enough. As a matter of fact, they couldn't even keep up with the demand because of supply chain issues due to COVID. So here we are now, 2025. The last 3 years, we've been in a position where buyers, again, are not buying en masse because rates have gone up. They can't afford the payment that it takes to buy a home, and so they're sitting on the sidelines. But they're waiting for interest rates to come down. And as soon as interest rates come down, those buyers are going to jump back into the market. And when do rates come down? I just showed you when rates come down. Rates come down in a recession. Recessions lead to lower rates. Why? Because the Federal Reserve has 2 simple jobs. They have to keep employment high and inflation low. And when people lose, they have to pick between the 2. Jerome Powell right now is saying, look, we might have a problem with both. And I'm going to focus on the one that is the biggest of the 2 problems. When you get into a recession, you're looking at the Federal Reserve needing to lower interest rates to spur growth, to get people to start spending money, to get companies to start investing. And so you have lower interest rates brought on by the Federal Reserve, brought on already what we're seeing right now in this whole debacle we've been dealing with over the last week or two about the trade wars and tariffs, is the 10-year Treasury dropping significantly because it's expecting the Fed is going to lower rates more. It's expecting that we're going to hit a recession. Now, that's in part a good thing for the economy as well, because it lowers the federal government's cost for paying for all of its debts. If rates come down, just like it makes it easier for you as a homeowner to pay for your home when you have a lower interest rate, well, the interest rates on federal debt is based on what the 10-year Treasury is and what they've sold Treasury notes at. And so if that comes down, it costs the federal government less money to service their debt. They can use that money to potentially lower taxes, to invest in the economy, lots of things they can do, lots of moving parts here that can fall apart. But the thing that happens consistently over and over again is recessions, lower interest rates, and increased housing prices. The only exception to that was the 2008 financial crisis, and that's when housing prices did not come up, but that was because that crisis was caused by housing, not because of any other reason. And the recession that we are likely heading into, that we're potentially heading into, is not caused by housing. So you're not going to see, statistically, based on history, you're not going to see housing prices drop. You're going to see volatility heading into the recession and during the recession. But coming out of it, you're going to see lower interest rates. You're going to see people feeling better about the economy as we're coming out of a recession. And that's going to put them into a mood to want to buy a home. And there are still not enough homes built for the number of people that want them. So that's going to create a supply and demand imbalance, or exacerbate the supply and demand imbalance, which is why I believe that home prices will go up if we end in a recession and interest rates will come down. If you have any questions about this or anything else, please reach out to me. Please know I'm interviewing to be your lender. So if you need assistance with anything, if you want to talk through what this means to you, if you're looking to take out a home equity loan or line of credit to pay off debt, do home improvements, or build a reserve fund, reach out to me and I can do that for you as well. I really appreciate you listening, and I hope you have an absolutely wonderful day. We'll talk to you soon. Bye-bye.